Hey everyone, Mo's here from Wall Street from Main Street, and I wanted to do a video to talk about some other trading ideas that you guys could check into and do some research on. Last week I did a video looking at the stock market and gold and silver and one gold stock. So this week I'm gonna look at the retail and restaurant industry, which I think is on a brink of a downturn due to various macro data that I've looked at. So let's look at the macro level for that industry so I can show you why I think it's a good time to start looking at that industry for shorting ideas. Um, so if you look at the retail sales year over year, it has gone down compared to what it was um, in early 2010, 2011. As you can see in this chart here, this is retail sales year over year. As you can see, it started to decline. It peaked in 2011 and has been on a down trend ever since. And right now, it's been sluggish. It's pretty close to reaching the negative territory. Uh, and if you look at the history here, when we had the 2008 collapse, you can see the sales and the retail industry suffered a lot. And also back in 2001 also, you could see there that the retail industry also struggled there. So look, see here what happened in the past 2 years. Retail sales have been very sluggish, slow, little growth here. So that to me is a bearish sign for that industry. I'll post this link. You can see the table here for all the industry. And you can see here the food and beverage stores have suffered a lot. For example, the grocery stores 1.1% last year in July and June 2016, negative 0.9%. Another one to look at is the retail and food services, 2.3% last year, and now 0%. So you can see here that this industry is starting to suffer. Again, food services and drinking places, 5% last year, negative 0.2%. That's a big decline right there. So something to keep your eye on. And also, another article that I'll link to this video. Now, Bank of America did a study on spending habit for the past 4 to 5 years, and it hasn't looked good. So I just want to show you one chart for the food service and drinking places. They broke it down using their data that they have on their debit and credit card for their own customers. And you can see here for the bars, caterers, fast food, and eating places, it had been in a downtrend since 2015, as you can see here. So, and this industry is pretty much holding up the job numbers. Because as you know, every month they put out the job number. They say we created 200,000 X amount jobs, and most of them are from the restaurant industry. So if the demand is not there, then that's not good news for people that work in that industry. So that is why I think the restaurant and retail industry is a good place to look for if you want to short some stocks. So let's look at one retail stock that was in the news lately, and that was Macy's. And as you heard, Macy's decided to close down 100 of their stores, which is not surprising considering if you look at the foot traffic that's been going down in the shopping malls. And also, if you ever step into Macy's, you notice that they have a lot of sales going on, whether it's the buy one get one free, 50% off, 75% off. I see it all the time there. Now look at this chart here. It peaked at $73 last year, and it's been a decline ever since. Now let's zoom in here and look at what they've done in the past year. This is a 1 year chart. As you can see, there's a support right here around the $30 mark here. So for people that want to short this stock, if it can break the $30 mark, we have a good opportunity to get in. Now, after the announcement of the closing of 100 stores, the stock did not go down. It went up actually. And the reason for that is because they announced that they're going to sell their retail property that they have. Now, I don't know if you noticed, but Macy's has some prime location in all the major cities across this country, whether DC, New York, San Francisco, LA. Their store is right in the middle of downtown, which is a great location, and a lot of traffic there, and a lot of value there. And their real estate value is, from what I read, it's about $20 billion, if I'm not mistaken, which would be good for them in the short term. But again, they're not a real estate company; they're a retail company. They have to sell clothes. That's their business model. They're not in the business to be in real estate. So in the short term, that'll be helpful, but in the long term, I don't think that's going to save them. And they said they're going to focus on e-commerce and online sales. That's going to be tough because you're going to be competing with Amazon and Zappos and all the other retailers out there that's already online and way ahead of Macy's. So it's going to be a tough battle for Macy's. We're going to have to see how they do, but if you want to short the stock, just look for them to go below the $30 mark. That'd be a good opportunity for you to get in. Now, next, I want to look at the restaurant industry. Now, I think the restaurant industry has, if you look at the chart, a lot of them have done very well. If you look at Texas Roadhouse and Dardine had done okay. Chipotle had taken a big hit. That's mostly because of the food poisoning problem that they had earlier this year, and we wrote about it in our 2015 report as a good shorting idea for anybody out there that want to buy put option or short the stock. Well, right now that stock's around $300. When we wrote the report, it was around $500. So if you shorted that company, you made a good profit there. So congratulations. So let's look at the restaurant industry, and this article here validate what I believe is coming for the restaurant stock. And this guy is saying that there's an analyst that's been saying that the restaurant stock is heading for a recession, quote unquote, and he downgraded most of his restaurant stocks from hold to buy to either sell or hold, as you can see in this table here. And he gave the stock target below the selling mark. So right now, Chipotle new stock target is $215. Dardine $53. Panera Bread $175. So this guy's bearish on the restaurant stock industry, and I agree with him there. And two main reasons for that. One is discretionary income is down. A lot of the middle class cannot afford to go out and eat as much as they can. And another thing is the restaurant is starting to struggle with wage inflation. As you know, a lot of people are demanding higher wages, especially in the restaurant industry and retail industry. And a lot of politicians are passing laws to increase minimum wage from $7 to $8 to $15. So that's going to have a negative impact on the restaurant industry, no question about that. So that's going to eat into their profit margin, and they're going to have to start closing stores and laying off people. So that's not a good thing for the restaurant industry. Another thing that I noticed about the restaurant industry is that the same store growth has declined. If you look at Shake Shack, their same store growth has declined year after year. If you look at Texas Roadhouse, their same store sales growth has declined as well. So if they cannot maintain growth in their existing store, then they have to keep building in order to increase revenue and increase profit. That's not a good thing, because eventually they can't keep building and building new restaurants or new stores to increase their profit and revenue. Excuse me. So that's a bad sign, and that's a bearish sign to me. So let's look at some of these companies. First one I want to look at is Texas Roadhouse. Now, Texas Roadhouse has done very well this year. It was at around 35 and went at high as 49, which is not bad. Um, but if you look at the PE ratio, I think the stock is way overvalued. Look at the PE ratio; it's almost 30. Uh, Almost at 30. Way overvalued. And for a stock that with sales growth that's slowing down, I wouldn't invest in a stock. I would actually look at this stock as a potential uh, company that I want to short or buy a put option on. So if you look at the chart right now, here's the support, and right now it's around $42, and the resistance is up here where the all-time high is, and that's at $49. So just keep your eye on this. If it breaks your support, with high volume, might be a good idea to short this stock. Um, Another stock I want to look at that's already in big trouble is Ruby Tuesday. Now Ruby Tuesday, I don't eat there. I haven't eaten there in a long time, and that's because the food is not good, and they're getting killed by the competition. On top of that, the economy's not doing well, and they just announced that they're going to close 95 stores. So I think this company is headed to bankruptcy. As you can see, they're having a terrible year. They started at $5.50 and are already below $3.50. And you can see they broke their support level right here on high volume. So I think this company is going to go further down. So if you want to, this is a good opportunity to trade this stock if you want to do that as well. Another stock I want to look at is Red Robin. Red Robin was a popular burger place. 10 years ago, it was a great place to go to. Now, if you go out there on the street, there's many burger places you could go to. So, no question the competition has hurt Red Robin. Red Robin is more of a family place, so it's mostly busy only in the evening and the weekend. But during the day, it's not that busy. So that's what's hurting them right now. And if I want a burger, I would not go to Red Robin. There's a lot of other places that have better burgers than Red Robin. And you can see here, here's the chart for Red Robin. Let me zoom out, give you a better idea. As you can see, they're not having a good year as well. Just over a year ago, they were $95 and has been in a decline ever since. As you may know, they recently put on board a new CEO that will try to change things around. So we'll see what happens there. But this is a stock that is on a downtrend, and it's due to competition and also the economy not doing well as well. So this is another company that you could keep your eye on. And also one other stock I want to look at, and that's Ruths Chris Steakhouse. I don't know if anybody ever heard of them. They sell incredibly expensive steaks for people out there that want a quality steak. I think the food on their menu is at least $30. So something like, it's similar to Morton's Steakhouse, if anybody ever heard of them. So you can see here they recently reached their all-time high, $18.78, and have declined ever since. And they have beaten earnings, but if you look at their earnings, they recently did a buyback back in April. And they did their buyback in April in 2016 at $50 million. And despite doing that, they missed their earning by 1 cent. So anytime you see a company doing stock buyback, that's a red flag for me, because a lot of companies are doing that just to beat their earning. I call that earnings manipulation, when they try to do stock buyback so they can beat their earning. That's not a healthy company to me if they're doing that kind of thing. So that's something to keep your eye on. So this company is another company you want to keep your eye on for trading ideas. So that's all I have now. Be sure to check out all of our other interviews on our website, on YouTube, iTunes, and Stitcher as well. All right, everybody. Good night.